Welcome back to the program. You're listening to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, coming to you on a host of stations throughout the Central Florida region. Also available on any number of podcast platforms as well. So if you have trouble finding us on your favorite podcast channel, just go to our website, nelsonfinancialplanning.com. There you'll see a bunch of icons. Click on the one that looks most familiar to you, and you'll get immediately connected to our channel. Once there, make sure you subscribe, and then that way you'll get notified when we upload new videos or new podcasts to those channels. So my name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks, one of which is sitting next to me, Kristin Kalley. Welcome again to the program.
Hi, Joel. Welcome. Thank you.
Kristin is a certified financial fiduciary, a certified financial planner, and a CPA as well. So obviously that means we're talking a little bit about taxes. Before the break, we were talking about this big push that we've seen rising its head out of Washington over the course of the past 25, 30 years, this notion of encouraging people to do the Roth and as a really more of a revenue raise for the government. Now, again, we're not saying that the Roth might not be a good option for you, but far too often, Kristin, as you were sharing that story before the break, people just kind of jump to this notion of, oh, I'm going to convert or I'm going to do the Roth, and don't really think it through, don't really think about how it relates to their personal situation.
Right. Some people see it as an all or nothing approach where you need to convert everything today, where we see it's most beneficial if you kind of spread it out over a couple of years. But every situation is different, so we like to run that analysis.
Well, and that's something that is unique at Nelson Financial Planning because we actually do have a tax department. Kristin, obviously you're part of that tax department, and we actually run the tax return. Rather than just kind of writing some numbers down on a piece of paper, we're using some pretty high-end software that we use for all of our tax preparation process, and ultimately that gives us a pretty good comfort level that we're giving you a pretty accurate estimate of what that picture would look like and whether it makes sense to do any kind of conversion or whether you fund the Roth accounts along the way or whether you fund the traditional side.
Right. Both have their benefits.
Both have their benefits indeed. So let's break it down. So we got 4 different kind of ways in which the folks in Washington have really been pushing the Roth. What's the first one you've got on your list?
Yeah, so we've talked about this one on a few shows before. So it's now adding a Roth option for employer matches. So previously, if you're contributing to your 401k, you have the option to make your contributions either pre-tax or Roth. And then your employer match, which usually is about 3% or so, would have to go into the pre-tax category. That was the only option. In 2023, they opened up a Roth option for those employer matches. Many platforms have not rolled out this change yet, so you may not have seen it. We might start seeing it more in 2024. But this is a way to get some more tax revenue because those Roth contributions or Roth matches are going to be taxable in your taxable income.
Well, and the interesting thing about this, and I think we've talked a little bit about this earlier in the year when this first was kind of getting introduced, is that if you're the employer and the employee, this is a pretty unique, this one has a pretty unique feature to it when you're the employer and the employee, that's for sure.
Right, because you get the deduction for making a matching contribution on the employer side, and then you would have to report it in income, but that offsetting deduction in income essentially makes it tax-free.
Yeah, it's really a great option for employer-employee. That's why I'm not, I think we talked about all of this stuff. It keeps evolving, right? They keep changing the rules. They keep saying, okay, well, this is fine, but in this particular situation, it's going to be a little different. So we obviously, that's why we do the show every week. That's why, Kristin, you're regular on the program as well, is to talk through this and to keep people informed on what they need to know, because we've certainly seen a number of these things that we're going to talk about today have in fact changed over the course of this year as well.
Right. And, I mean, this one came out for 2023, and we still haven't really seen it as an option for a lot of people yet.
Right. So what's next on the Roth push, if you will, out of Washington.
Yep. So now simple IRAs and SEP IRA plans now have a Roth option. And this is going to be available for employee contributions as well as employer matches or employer contributions.
So that is helpful because now, and different in the past, because employer contributions, particularly on these kind of smaller plans, were not able to be Roth, but now they're going to be able to be on the Roth side as well.
Right. And for a lot of self-employed individuals, the only way that they could contribute to a Roth would have been a Roth IRA, which has limits of, it was $6,500 for 2023. It'll be $7,000 for 2024. By giving this Roth option in simple and SEP IRA plans, they have the option to contribute more to the Roth side.
Gotcha. Okay.
Higher
Well,
limits.
Yeah, that's good. Obviously, with the higher limits. Now, this next one is one that's kind of been one of the ones that has changed somewhat over the years. This has to deal with that catch-up contribution that people can make.
Right. So the catch-up for high earners, which is going to be classified as if you make $145,000 or more. So starting in, it was supposed to be 2024, but it's been delayed to 2026. So if you make that catch-up contribution, it's for $7,500. You can only make it to the Roth category. You cannot make a pre-tax contribution.
I mean, a pretty good example of how the folks in Washington have said, wait a minute, we need tax revenue. And particularly if I'm a higher income earner, right, because this only applies to higher income earners, then, they're generating more tax revenue if we require them to do the Roth, particularly for these after-tax contributions. Now, this one was met with a lot of resistance, more from the practical point of view, right?
Right. I think that's why they keep delaying it. It's just hard to get it implemented.
Right. Yeah, well, it's definitely impacts those folks that have higher income that might benefit more by doing that catch-up contribution on the pre-tax basis, which is what it's always been allowed to be done. But now to be forced into the Roth, okay, that is raising your tax bill. That is creating more revenue to the government, and that ultimately is certainly the current underlying all of these changes that we're talking about. So what else is on our list here?
Yeah, the last one, this doesn't actually bring Washington any revenue, so this is a nice one.
That's a miracle. They actually did something that didn't line their coffers. Okay, what's this one got to do?
So with the 529 plans, what you can do is roll over some existing balances to a Roth IRA for your beneficiary. So if it's for your child, you can set up a Roth IRA and transfer the funds from the 529 into the Roth IRA on their behalf. Yeah,
this certainly is an interesting one, and one that I know you and I have talked about a bunch over the course of the year. You know, the one thing about the 529s that I think is important to remember is that they're kind of an evergreen account. Right? So you don't have a particular age where you have to take the money out versus, say, a Coverdell educational savings account where it's money can't be in there until after age 30. You have to make sure that the money is coming all out. Whereby a 529, you can kind of leave it and sitting in there. So I kind of go back and forth on kind of what's the best option on this one. Do you leave the money, let it sit, continue to grow? Because with 529s, you can always change the beneficiary.
Right. Yep.
You can change the beneficiary to potential future child down the road. I mean, you start to spin that out over an extended period of time. There's really some value about if there is a residual balance in a 529 account. Once that child has gone to school, then maybe you do just kind of leave it alone. Certainly, this is another option to be able to kind of use that money to fund a Roth. My reaction is hopefully they're working. If they graduate from college, hopefully they're working and can get some money to fund Roths on their own.
Yeah, or you could really do both because the Roth IRA option is only limited to $35,000. So if there is residual over that, then you could leave it to a future grandchild or along those lines.
Correct. Although with the cost of education, hard to have a lot of residual balances left over on these 529s. But yes, those obviously underscores the general trend in Washington. When we get back, we're going to go through kind of the normal inflationary adjustments and what that means for you. Ultimately, it means good things for your taxes, more money in your pocket. We'll talk about all of that when we return here on Dollars and Cents with Joel Garris and Kristin Kalley of Nelson Financial Planning.